Everybody needs to be prepared to deal with the volatility, and everybody needs to think long term. And because long term, I'm quite confident that this is going to be a multi-million dollar per coin asset. And so if you're buying it at 72 today, you're feeling, I mean, it feels like you're paying too much, but I one of the great stories from Madeira, somebody told me they knew Max pretty well. I guess when Max was buying his first coins, he paid, and this is Max Kaiser, he was paying 50 cents. And he felt like he'd overpaid because Trace Meyer, who's a true OG, was buying his at 30 cents. Buy what you can because it's a superior savings technology, and then sit back and go live your life and do things you enjoy, knowing that your money is not being debased.
Lawrence Lepard is a sound money advocate, Bitcoin enthusiast, and investment manager with Equity Management Associates. As a gold stock fund manager and a sound money advocate, Lepard spent decades advising investors to avoid the constant debasement of fiat currencies by investing in gold. However, with the creation of Bitcoin, Lepard's task has become easier because the leading cryptocurrency is the better alternative, a digital gold, if you would, that offers adequate protection from fiat debasement, along with many other important qualities you cannot find with gold. During a recent interview with Natalie Brunell, Lepard gives an ultra-bullish price prediction for Bitcoin, stating that the leading cryptocurrency will someday be worth millions of dollars per coin. This ultra-bullish prediction for Bitcoin is not just a result of the constant fiat debasement, but also because of growing concerns that the situation is about to get much worse in 2024. During his discussion with Natalie, Lepard references Biden's recently announced $7.3 trillion budget proposal and ISDA's letter to the Federal Reserve, FDIC, and Office of the Comptroller of the Currency to urge them to implement targeted reforms to the Supplementary Leverage Ratio, SLR. Lepard explains that these are all critical indications that America's debt is about to become so much worse, even worse than the Congressional Budget Office's estimates. We will now bring you clips from Lepard's interview with Natalie. But before we do, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks, and enjoy the video.
The big picture is the things that we've been warning about for some time now, many of us for years really, but more recently, the last few years, are all starting to kind of come together. $1 trillion of debt added in 100 days, and record deficits, no spending restraint by Congress, the approval of the ETF, and the multiplier impact that's had on the price of Bitcoin. And as we know, it's kind of been a relentless uptrend, strong and up to the right since 50,000 when the ETF was approved. And there's another thing, probably a lot of people didn't focus on it, but I did, and it's a big deal. There was a letter from the Industry Swaps and Dealers Association to the Federal Reserve saying, hey, you know what, we really think you ought to throw away this SLR, this limit that you place on the banks and their ability to buy treasury debt. And of course, the reason for that is that there's a lot of treasury debt to be sold, and the number of buyers are slowly but surely shrinking. And if you really read through the lines on that carefully, and it's a lot of inside baseball and monetary plumbing, it's more or less kind of QE infinity, or it'll give the banks the ability to just in an unlimited way monetize the debt and put it on their balance sheet because they don't have to count it as a reserve, and so they can more or less print money to buy the government debt. So it hasn't been approved yet. It was a letter, but it's clearly those kinds of things. They start with a letter and then they come with a Federal Reserve proclamation that this is what we're going to do. And they did it in 2020. And they did it in 2020 because at that point in time, they needed to do it because the debt, they were having a hard time selling the debt then as well. So to me, it's a big deal. And I'm not sure the market's fully absorbed it, although, you could also argue maybe the market has absorbed it because the two sound money assets, gold and Bitcoin, are both at record highs, or, very close to. Gold's backing off a bit today, but gold had been constrained within a range of kind of a $2,100 top, $2,050, $2,100 top, and it broke through that rather decisively in the last couple of weeks. So, I think the wider world is awakening to the issues that many of us in this area have been talking about for some time, and that is that we have a sovereign debt problem, and that the likelihood is that the solution of the government will be to monetize it, and that goes to the letter I just referred to. So So that's kind of the climate we're in, and I kind of see the sky as the limit for both of these assets. I expect they'll be higher in a month, and I expect they'll be much higher in 6 months. I mean, Biden is talking about trying to tax the rich. The increase in the total budget size is enormous. I mean, I was reading something in the Wall Street Journal this morning talking about how the whole budget was really a fantasy, because a lot of what he's projecting just isn't realistic. I mean, I find it amazing that the CBO is projecting not that great an outcome for the next 5 or 10 years, and they're saying there won't be any recessions in a 10-year window, and they think that inflation and interest rates are going to go back to 2 or 3%. And I'm like, what planet are these people living on? So, yeah, it's we live in a financial fantasy world, really, that these people have kind of constructed. But there are some free markets. Probably Bitcoin is the freest of all the markets in terms of lack of manipulation. And guess what? They get it. I mean, Bitcoiners get it, and people are getting it, and they're saying, okay, if you're going to debase my currency, I'm going to buy a currency that by definition cannot be debased above and beyond the programmatic formula. So, and this is why Bitcoin's at new all-time highs, and I expect it's going to go much higher.
On March 5th, the International Swaps and Derivatives Association, ISDA, submitted a letter to the Board of Governors of the Federal Reserve System, the Federal Deposit Insurance Corporation, FDIC, and the Office of the Comptroller of the Currency, the OCC, urging the agencies to implement targeted reforms to the Supplementary Leverage Ratio, SLR, and Enhanced Supplementary Leverage Ratio, ESLR, and risk-based surcharge for global systemically important bank holding companies, the GSIB surcharge. According to ISDA's letter, these are important to preserve the resilience of the United States Treasury markets and the U.S. economy and financial system more broadly. With the letter, ISDA is looking to facilitate the participation by banks in the U.S. Treasury market by urging the agencies to revise the SLR to permanently exclude on-balance sheet U.S. Treasuries from total leverage exposure, consistent with the scope of the temporary exclusion for U.S. Treasuries that the agencies implemented during the pandemic. While these words may seem harmless to an unsuspecting person, Lepard warns that it's a huge sign of impending danger. Here are more clips from the interview.
So the problem that I think the government is going to have as they continue to run these deficits, and as they continue to go into, so let's keep it really simple. 101, the government spends more than it takes in tax revenue. We know that, and it's getting worse. How do they finance that? They finance that by issuing a bond. Okay, the bond gets an interest rate price gets set on that bond, which is a reflection of the supply and demand for those bonds. And if there is no demand, kind of by definition, that means the interest rate price has to get higher, and that higher interest rate price would then lead to more interest expense for the government, which it would kind of lead to what James Lavish has said so clearly is a debt spiral or a debt death doom loop. And so the federal government and the Federal Reserve have a real incentive to try and keep interest rates under control. That's a key piece of what they have to do, because if we went to, we're at, on the 10-year now, we're in the 4s, but we were at 5, and we saw how that created a problem last fall. Mm-hmm. And so if we went to 5, 6, 7, 8 on the 10-year and higher rates on the, or similar rates on the shorter durations, the government interest expense would blow out even further. And it's already blown out. It's over $1 trillion a year, up from much less than that 3 or 4 years ago. But and so it would accelerate the funding problem and the financial problem that the government has. And so as a result of all of that, the government and others are looking for ways to find more buyers of those bonds. And because to the degree that they can find a buyer that creates supply or creates demand, which would bring interest rates down, and that's what they want to have happen. They want to have interest rates come down so that their funding costs are lower. The banks can buy these bonds, and often they do, and then they quickly flip them to the Fed or flip them to somebody else, or they can leave them on their balance sheet, but they're somewhat constrained in terms of what they can leave on their balance sheet because of what you referred to, the SLR, the supplementary leverage ratio. And it's confusing, even to experts like me. It's somewhat confusing how this whole mechanism works, because it's kind of tricky monetary plumbing that nobody really pays attention to. But boy, when this ISDA letter came out, those of us who were in the know, Fed Guy 12, Joseph Wang or Luke Groman, or those of us who are watching the Lin, or those who are watching the monetary plumbing very carefully, like, holy shit, if I'm reading this correctly, this means that these banks can buy as many of these bonds as they want, no problem, and they can create the money to do it. And so that, it's kind of, broadly speaking, it kind of looks like QE infinity. Now, because of the way it's sort of backdoor and subtle, obviously the Fed right now, if they were to stop QT and announce QE, that would be seen as being massively inflationary. And that would not be a good thing for them. That would not help in their fight against inflation. But if they can get the banks to do their dirty work by changing the regulations that the banks are underneath, hey, that's great. They get to the same place. It's just not called QE. So I think that's kind of my synopsis of what's going on. I mean, there's really a collaboration between the banks and the government to keep this whole scheme going. And so, this allows the banks to benefit. And, one thing we don't know is we don't know the differential pricing on some of the things. We don't know my gut is, and this gets really tricky, and Lynn's a better person to ask about this because she's just so much better at the plumbing of the monetary economics. But, it's very possible that, like the reverse repo and other tools they've used, they'll figure out some way to make this more profitable for the banks because, the banks don't do anything unless there's profit involved. So, but, and we haven't seen that yet, but we will. I mean, I think that the description of how they're going to do this, I'm guessing this will come out sometime in the next few months. And this letter was a shot over the bow.
With almost $200 trillion in funded and unfunded debts, debt to GDP of over 120%, and rapidly growing interest expenses, it is quite clear that the United States is on an unsustainable fiscal path. An unsustainable fiscal path is the exact phrasing of the U.S. Department of Treasury, as stated in the Executive Summary to the Fiscal Year 2022 Financial Report. Macro analysts and prominent investors, both from the traditional financial sector and alternative sectors like Bitcoin and gold, have been talking about the brewing debt storms for years. Prior to 2022, with interest rates kept artificially low for such a long time, it was easy for policymakers to downplay the problem and make it seem like all was well. That's quite impossible now. The cracks are not just showing. They are practically tripling over themselves now, so that institutions that previously backed the reckless monetary policies and even benefited from their follies are now forced to speak out against the situation. The most recent example is Chairman Jerome Powell's statement that the US is on an unsustainable path, and the only way forward is for decision makers to have some serious discussions about the way forward. What are your thoughts on Lepard's interview? Please drop your comments and observations in the comments section below. Also, ensure you give this video a thumbs up, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.